Welcome to another video. I hope you are doing well. Today, I want to talk about one of my key principles when it comes to investing. This will be the main topic. The second part of the video will be about current topics in the stock market. We're going to talk about a little bit about two companies, Netflix and Spotify. Those are currently very well discussed on YouTube. And I just want to provide a little bit of my perspective on those companies. And in the last bit, we have again our Q&A. So if you have any questions during the video, just put them down in the comments if you watch this live and you want to get your question answered. Maybe we'll get to it in the end. If you watch the recording, feel free to leave the question in the comments and I will get to your questions in one of my future videos. So the main topic, the main principle for investing that I find is most important to me is the low risk, high return way of investing. And it literally comes down to value investing. And I wanted to do a video about this topic because I recently read again the Dhandho Investor from Mohnish, Pabrai. I have the name in the description as well. I really like this book and it's just amazing. He tried to describe the way he invests and the way he thinks is the best way to invest in his book. Very practical. He describes individuals that run companies and that have created companies in a very, very unique way and in a way that was very successful. All those individuals started basically from zero and they tried to create companies in a way that they really could not, either they could not fail, so the chances of being successful in the business were very high. And if they would lose, if they would go bankrupt with that company, they would literally not use much. That means they would not put a lot of their money into risk. And the same approach he uses for investing. And he's not the only one who is basically using this as a mantra for investing. There's also another YouTuber called Sven Carlin. He preaches value investing, and this is basically the phrase he uses in every of his videos. And I really like that he's pushing this concept so much forward, the way of low risk, high returns. And I think it is so important because in life, very often we actually use this method. But when it comes to investing, we always get confused on the way that principle can apply there too. And we actually use it in reverse, or we think about the stock market in reverse of this principle. So I just wanted to provide a very simple example. For example, if you go shopping and you always had in mind to buy a specific thing. It can be anything. It can be a car. It can be, I don't know, a very cool technical toy that you always wanted to have. And this is on special deal. You know the price that it usually is. It's $200 for the electrical gadget or the I don't know, the new camera or whatever you want to have. And it's now on half price. You get it for $100. You see this and you think, this is amazing. I want to buy that because I know the true value of this device and I want to have it for half the price. This is amazing. I always wanted to have it. So if I can get it for the half price, I make an amazing deal. Same with cars. If I know I want to have a specific car and I know roughly what they are traded for, if it's a used car, and I get it for $3,000 less, it's amazing. I feel good because I make a good deal. I buy this for a bargain and I know I get great value for my money. But for investing, all people always get confused by that concept, and they actually use it in reverse. When prices are very high, people think, oh, I need to get into the share market and I will get exactly the same returns that have uh, those companies provided in the past. But the truth is exactly the opposite. So when I try to calculate the true value of a company, I do that independent of the share price. I'll try to do my research on a company. I'll try to understand the company as good as possible. I'll try to understand how much cash flow this company can produce over a long period of time. And this way, I try to calculate the intrinsic value of a company. There are also many different factors when it comes to determining if I think a company could be a great investment. Is it a good management team? Does the company have a moat? Is it a durable product or service that this company uses? All those things have to be factored in as well. However, when it then comes about determining if it's a great time to buy the stock, we also look at the share price and we compare our calculated intrinsic value with the current share price. And if we have done our research, if we think it's a great company with a durable advantage, with a moat, and the share price is low, it's an amazing opportunity for a value investor to buy this company because we understand it is currently on discount. We get a great company, a great product for a very low price. And this means that the returns for these great companies can only be higher in the future. When I get something for very cheap and I know it's a great company, I know the price will come to a level again where the share market appreciates that value of the company. I know I will have higher returns as if I buy this company for a very high price. And this is exactly what we do when we buy goods, when we go out and look for that gadget, or when we look for the car, and we know those concepts, but for investings we always get confused. And also the academic system teaches something different. When we look, or the universities in investing, they teach that investing into the stock market and into individual companies has a very high risk. And if it's a company that is currently going through a disruption, either because of a broad market disruption or because there is something currently not lining up with the company, it's usually considered a high risk investment, even though it is the opposite. So academia is often get this wrong and describing it wrong. And that's why it's so hard for people to understand. And when we look at media, we also see when the share prices are high, media is talking about those great companies with those great high share prices and what returns they have delivered over the past. But when we invest into companies at those times, we obviously are investing at a time when the price is already high, and we want to invest for the time after, and we are not able to invest for the time in the past. So we are actually investing then at a time when the price is high, and we will automatically have lower returns automatically. And therefore, the low risk, high return approach and principle is the one that I find most important to understand when it comes to investing, or one of the most important ones. And again, that's why I can everyone recommend that book. It's amazing. And no, I don't get any Amazon affiliate links if you go and search and buy the book. There's no link in my description. So I really just recommend it because I truly think it's a great book. And while we're talking about books, I just got this delivered today. I read it already, but I wanted to have the hardcover as well. Is The Education of a Value Investor, another great book that I can recommend. It's from Guy Spear. I really love the book. It's actually not only about investing. I think it's also about a lot about life, and I really value that Guy Spear opened up so much in his book and shared his values, his beliefs in this book. And he loves the principle of compounding goodwill. So something to read there as well if you are looking out for another book recommendation. All right, going back to the topic, I want to bring up two more things from Benjamin Graham. He's the godfather of value investing. He wrote the book The Intelligent Investor, and Warren Buffett actually was able to learn from him in person. So Benjamin Graham actually taught, and Warren Buffett was able to learn from him. And there are two things that he describes in his books that I just wanted to point out, and that are so important for value investing. A stock is a piece of a business. Never forget that you buy a business that has an underlying value. So it's not the stock price that you buy, but you buy a piece of a company that has a specific value. And the stock price can be up or down depending on the current market situation. However, the price is not always reflecting the actual value of a company. This is important to understand, that this is not connected, and therefore we as value investors want to find times when the share price is low but the underlying value of a company is higher than the share price. The other concept I want to point out from Benjamin Graham is the margin of safety. It's another principle that is so important. Whenever we make an investment, again, we do our research, we see what the share price is, and we potentially think it's a great time to buy. But we always should include in our calculations a margin of safety, because we always can be wrong with our estimations or our calculations, and therefore we take our calculations and we reduce it by another amount, whatever that might be, if it's 15%, 20%, or 50% for that matter, to ensure that even if we are slightly off with our estimations, we still can make a positive investment case. And the other thing I wanted to pick up from Benjamin Graham is that Graham was fixated on two joint realities, and I mentioned that already with my little phrase, low risk, high returns. And the two joint realities that Benjamin Graham describes in his book, The Value Investor, is the bigger the discount to intrinsic value, the lower is the risk. So the more discount I have to the intrinsic value that I calculated, the lower is the risk that I have as an investor. And the bigger the discount to intrinsic value, the higher the return will be. Yeah, that means if I buy that company for cheaper, it will deliver higher returns in the future. All right, I think this is enough preaching for me, and I know it's probably a little bit over the top. However, I think this is just so important to understand. And if you listen to this, if you watch this video, try to think about it, and try to think about how you use this approach in your normal day-to-day life. And maybe you see this, that you're actually living that already in your normal, when you do your normal purchases, but you potentially not applying it when you are investing in the stock market. All right, coming to the next bit of our video, the current market situation and the current topics. And I want to talk about two companies, because they are potentially creating a great investment opportunities. I'm not invested in those two companies that I will talk about, just as a disclaimer. But I think it's an interesting moment in time where the share price got down, and the companies certainly seem to be to have a long runway ahead, and they are certainly delivering high cash flows at the moment. And the two companies are Netflix and Spotify. And Netflix currently got included, obviously, in the overall tech drawdown, so got Spotify. But for Netflix, there was one specific situation just a couple of days ago. It actually missed on its growth targets. And Netflix is obviously a very growth-orientated company, and the product is growth. It's still growing heavily. However, the growth targets were missed, and this got investors to sell heavily. The stock actually got literally hammered down, and this can present potential great opportunities for investing. I'm currently have not done enough research on Netflix to be able to make an investment case for or against Netflix, but I have seen a lot of great videos popping up on YouTube about Netflix, and one that I want to mention is from Hamish Hodder. We actually did our fundraiser together in November, the Movember fundraiser, and we had a live stream together where we chatted. However, on his YouTube channel, in his last video, you find some information about why Netflix is potentially cheaper than you think. And he actually discovered some interesting calculations. And this is, again, another example why the market sometimes gets facts wrong, or just does their pricing based on facts that are potentially different from the truth that actually the company's structure and the company's values. And here it's about the actual cash flow that Netflix produces and the money that they spend, either for new subscriber, money that they have to spend to get new subscribers, or money that they have to spend to keep subscribers in their channel. And it's all about the idea of how the spending that they have gets put in their books, basically, and how it gets treated, how the tax gets treated on those investments. For example, those investments into making a film get or depreciate in value, and you can basically lower your income, your tax income. Anyway, Hamish is much better in explaining it in his video. But I wanted to explain is that the potential cash flow that the company is creating is potentially much higher than the current information that were released actually display. And for Spotify, it's a company that I'm currently following quite a lot and try to understand much better, because there's so much more about Spotify than I used to think. I thought Spotify is really just a platform where you listen to music, and I'm using Spotify already for years, and it's a great service. However, I never saw that there is more behind it than just this music streaming. And I believe that there is the potential for a great future for Spotify if they actually find a way to monetize the viewers and listeners even more than they already do. And this can be in different ways. For example, to connect to the merchandising stores from artists, or from the ability to publish advertising in podcasts through the platform, like YouTube does in their videos. And this can be future revenue streams in Spotify. And another thing that is just outstanding that I want to mention from Spotify is the percentage of paid users in their business model. They have a classical freemium model, so you can use Spotify for free. However, then you have to get some, you hear advertising during your listens, and there comes advertising once in a while. However, if you pay for it, there is no advertising anymore. And 50% of the customers that Spotify has, or around 50%, I think it's a little bit less, are actually paid customers. And this is amazing. And this number is very stable. So even though they have a free offering, a very big part of the customers are actually going and pay for the service because they want to listen to the music without the interruption of advertising. And while this also can be a conflict for future revenue streams, I think they will find a way to generate more revenue from and income from advertising through their platform and connecting to it. And another option can be, for example, hosting live events. So we obviously all are impacted from Corona and people are not going to live concerts anymore. Maybe there is an opportunity to have live concert within Spotify from specific artists, and you have to buy a ticket to go to this live concert on Spotify. These are just some ideas, and I picked those up in an interview that I also found on a podcast from Investing with Tom. He interviewed Jeremy Deal from JDP Capital on his podcast just 2 episodes ago. This was just an amazing episode, by the way. And Jeremy shared a lot about how he finds investments and what he thinks could be or are great investments. And he talks in detail about Spotify and what he thinks about Spotify. So if you like that, definitely go and listen to this podcast as well. I really can recommend this a lot. And for that matter, there are also a lot other interesting episodes on Tom's podcast. So go and check him out as well. All right, coming to the last part, the Q&A. And in today's Q&A, I want to talk about and it's a question that I get asked a lot. It's, what broker should I use? And I don't want to name specific brokers. However, I want to give you some ideas on how you can determine what a good broker could be for you. Because again, as always in investing, or very often, these are personal decisions, and it always comes down to what you want to achieve and what you want to do. And same with finding the right broker for you. So obviously every country has their specific brokers that are focused on this specific market. So depending on in what country you live in, you should look what the brokers are that are available to you in that country and what features they provide. How expensive they are, what exchanges they offer, where you can buy and sell stocks, so what exchanges they are connected to, and what type of products they offer. Are they only offering shares that you can buy and sell, or do you also have the opportunity to buy and sell options or other type of financial products, for example? And so this really determines on what you want to achieve. And some products even just have ETFs in their offering and not even shares. And obviously, another thing to consider nowadays, there are a lot of investment apps available to use to actually get started. And while I think it's a great way to get started and get exposure, I always would recommend to open a broker account with an actual broker where you have the ability to buy more than just shares, and where you have more information that you get about the companies that you can invest. You get more details about what the companies do. You potentially get financial informations. You get access to the annual reports. So some brokers, more established brokers, offer all that. And the so-called small smart brokers, where you potentially only have an app, you miss out on a lot of those information. They might be a little bit more expensive. However, the great advantage is that you get more information. And another thing is, I feel, is when you use one of those established brokers that you only can use via the browser, it actually feels more like real investing. In the app, it is all very gamified, and therefore it can be really easy to just buy and sell and buy and sell, and I buy a really small fraction of this company and of this company, and you get caught up in this buying and selling, which obviously creates and fees, and you don't think too much about what that actually means, because even though you use that smart broker, you are still buying a piece of that company, and it's And it's important that you understand this concept. And I think it comes clearer when you use a different broker and you get all the information via email as well, what you just purchased, and you have more research that you can do over those companies, and it feels just more real, and it provides you more access. And so this would be what I would do. I certainly would open an account with a proper broker that provides you just more information and more details, and potentially does not even have an app that you can install on your phone, because this just distracts you so much, and you probably end up looking at the stock every day, which just distracts you even more. So while I was not able to name some brokers because I just don't want to influence your decision there, I hope this was still a little bit helpful, and I think it's more around the mindset. So yeah, I think this was interesting to you. Thanks very, very much. And thanks for listening. Thanks, Jason and Neil, for your comments. And I love to see you in my next video. Until then, bye.